Before we begin, make sure you like this video and subscribe to the channel if you want more content about trading, money, and financial strategies that can change your future. Now imagine this scenario. You want to become a day trader, but there's one major problem. Trading requires capital. If you only have a few $100s in your account, it's very hard to make meaningful profits. One bad trade could wipe out your balance. But what if a company gave you $50,000, $100,000, or even $200,000 to trade with while you keep a percentage of the profits? That's exactly what funded trading accounts promise. Over the past few years, funded accounts have become extremely popular in the day trading world. Thousands of traders are trying to pass evaluation programs so they can trade with large amounts of capital without risking their own savings. But what exactly are funded accounts? How do they work? And more importantly, how can you actually get one? Let's break it down step by step. What is a funded trading account? A funded trading account is an arrangement where a proprietary trading firm, often called a prop firm, provides traders with capital to trade financial markets. Instead of risking your own money, you trade with the firm's capital. When you make profits, you share those profits with the company. For example, a trader might receive a $100,000 funded account. If the trader makes $10,000 in profit, the company may allow them to keep 70% to 90% of those profits depending on the program. This means the trader could earn $7,000 to $9,000 while the firm keeps the rest. For the firm, the model works because they evaluate thousands of traders and only fund those who demonstrate discipline and skill. Why funded accounts became popular? Funded accounts exploded in popularity because they solve a major problem that many traders face: lack of capital. Most beginner traders cannot afford to risk tens of thousands of dollars in the market. But with funded programs, traders only pay a small evaluation fee to prove their skills. If they pass the evaluation, they gain access to a large account size without putting their own savings at risk. This system has attracted people all over the world who want to become traders but don't have access to large investment funds. How funded trading programs work? Most funded account programs follow a similar process with 2 or 3 stages. Stage 1. The evaluation. In the first stage, traders must prove they can trade profitably while following strict risk rules. For example, a prop firm might require a profit target, such as 8 to 10%, a maximum daily loss limit, a maximum overall drawdown, a minimum number of trading days. Let's say you're given a simulated $100,000 account. The company might require you to make $8,000 profit without breaking any risk rules. If you violate the rules, the evaluation fails and you must restart the challenge. Stage 2. Verification. Some firms add a second step called verification. This stage confirms that your success during the first phase wasn't just luck. The profit targets are often slightly smaller, but the risk rules remain the same. If you pass this stage, the firm considers you ready for funding. Stage 3. The funded account. After completing the evaluation process, the firm provides you with a funded trading account. At this point, you begin trading under the company's capital allocation. You continue following risk rules, but now you can withdraw a portion of the profits you generate. Profit splits often look like this: 70/30 split, 80/20 split, 90/10 split. The trader keeps the larger share of the profit while the firm keeps the smaller portion. What markets can you trade? Funded accounts usually allow traders to trade several financial markets. The most common ones include Forex currency pairs such as EUR/USD, GBP/USD, and USD/JPY are extremely popular in funded programs. Stock indexes markets like the S&P 500, NASDAQ, and Dow Jones are also frequently traded. Commodities, gold, silver, and oil are common trading instruments. Futures. Some firms focus specifically on futures markets like the E-mini S&P or crude oil contracts. The allowed markets depend on the specific prop firm and platform. The risk rules you must follow. Funded accounts always include strict risk management rules. These rules are designed to protect the firm's capital and ensure traders remain disciplined. Common rules include maximum daily loss. You cannot lose more than a certain amount in a single day. For example, a $100,000 account might have a $5,000 daily loss limit. If your losses exceed that amount, the account is automatically closed. Maximum overall drawdown. This rule limits how much the account can decline from its starting balance. If the account drops below the drawdown limit, you fail the challenge or lose the funded account. Minimum trading days. Many programs require traders to trade for at least a certain number of days. This ensures traders demonstrate consistency rather than passing the challenge through one lucky trade. How much do funded accounts cost? Most prop firms charge an evaluation fee for the challenge. These fees vary depending on the account size. For example, $50,000 account challenge, $150. $300 $100,000 account challenge, $300. $600 $200,000 account challenge, $600. $1,200. This fee allows you to attempt the evaluation process. If you fail, you usually have to pay again to restart the challenge. This is one reason prop firms can operate profitably even when funding traders. The skills needed to pass. Many beginners assume passing a funded challenge is easy, but the reality is that most traders fail the evaluation stage. Success requires several key skills. Risk management. Professional traders focus more on protecting capital than chasing profits. If you risk too much per trade, it becomes easy to violate drawdown limits. Emotional discipline. Fear and greed are two of the biggest enemies in trading. When traders become emotional, they often break rules or overtrade. Funded programs reward traders who remain calm and consistent. A proven strategy. Successful traders usually have a clear trading plan. This includes entry rules, exit rules, risk per trade, market conditions to trade. Without a strategy, trading becomes gambling. The advantages of funded accounts. Funded accounts offer several major benefits. Access to large capital. Traders can control large accounts without risking their personal savings. Limited personal risk. The only money traders risk is the evaluation fee. Scalable income. As traders prove consistency, some firms increase the account size over time. This means profits can grow significantly with skill. The potential downsides. While funded accounts are exciting opportunities, they also have challenges. Strict rules. Breaking a single rule can end the challenge or close the account. Psychological pressure. Trading with strict risk limits can create pressure that affects decision-making. Evaluation fees. Repeated attempts can become expensive if traders fail multiple challenges. This is why preparation is extremely important before attempting funded programs.